Good morning, Armor Insiders. Everybody, welcome to our morning meeting. Thank you for joining me. This is our live trading desk. We're going to go from our morning meeting to our live trading desk all day. You're all welcome to join us. This is a virtual hedge fund experience. So for over a decade, I ran hedge funds, been managing capital for 35 years myself and for others. And so what I'm doing here is sharing with you our strategy, the ARMR investing way. ARMR stands for Algorithmic Risk Management Research. So we begin and we end our discussions on really how to manage risk. And then we try to figure out how to capture upside, which is a little different than most that are in this business. Okay. Although I would say institutions run money like that, right? So you got to manage risk first and then you capture upside. So that's our driving force. We're using algorithms to do it. We have 10 algorithms designed for the volatility of each asset, 10 indexes, 9 indexes in Bitcoin, okay? And when those 10 all tell us the same thing, we know it's time for us to either take risk or avoid risk. So we call that the risk monitor, all right? Everything starts from that. So we're going to go over this morning before the bell rings what the risk monitor looks like and what would have to happen to change it. Okay. Once that change occurs, then what we start doing is looking for where we want to invest. So between now and the change, our job is to build our list of top stocks to watch. I call them top shelf stocks on my whiteboard. And we're going to break those down in a minute between our different types of portfolios. So what we're doing here is we have 4 portfolios we run that make up our virtual hedge fund. We have our carry portfolio. All we do is carry Treasury bills and we trade the S&P on an intraday basis. So I'll go over what our targets are, how we intend to trade it today, then you can watch us do it all day, which is kind of like war. Like there's a whole bunch of doing nothing, and then there's there could be like 30 minutes of sheer terror. Okay, that's what day trading is. So we'll be doing that. We might be doing nothing for a while, and then all of a sudden we're very aggressive. Then we shift over to our macro fund, which is designed to really mirror the risk monitor. So we're trading indexes on a swing basis. The risk monitor is a swing trading strategy. Okay, we're using indexes, and I'm going to tell you, we've got about 30% of that portfolio invested right now, 70% in Treasury bills. And I'm going to go over what is the highlighted group of the day today that makes up that 30%. And that highlighted group does not follow the risk monitor, okay? It marches to the beat of its own drum. And that's why we've got an investment there. Quite frankly, it's the best investment of the year. And we just increased the size yesterday. I'm going to go over that with you. And I may be increasing the size again by the end of the day. Why am I doing this with you guys right now and going all day and making sure you all have access? It's because the weekly close is more important than any one day. So we got to see where we are at the end of the day Friday. And then we might make some bigger changes to the portfolio. Okay. And then, of course, we have our traditional investing portfolios, innovative growth, and our turnaround dividend portfolio, both of which have massive amounts of cash. But yesterday, we went from 100% cash in our growth portfolio to 60% cash. So we put 40% of the money to work yesterday. I'm going to go over what those stocks were. And then, of course, our dividend portfolio. We've got a lot of cash in there right now. When the bottom started falling out of the market, we raised a bunch of cash there, and we're happy to collect 4% Treasury bills for a while. There's nothing wrong with that. But I've got a list of stocks that I'm watching so that when volatility compresses again, I'm ready to put money back to work. I'm going to go over all that with you. And we have about 15 minutes to do it. So before I dive in, grab a pen, piece of paper, get yourself ready. Think of yourself as a portfolio manager on a hedge fund desk, okay? I'm going to share with you strategy. We'll call me the chief investment officer. And then what you want to do is figure out how that strategy fits into your own strategy. What's your risk tolerance? What's your goal? Execute your strategy. What I'm sharing with you is how I run money. That doesn't mean how you should do it, but it hopefully is a guide to the thought process of how to put capital to work and how to manage risk. So figure out your risk tolerance, your goal, execute your strategy, and be the smart money on your own. Okay. All right. Lot to talk about in a short window here, but I think we can do it. Let's start with the risk monitor. Risk monitor's red. The risk monitor went red on the 21st. As you can see here, that's right around the top of the market. We've been in a defensive posture ever since. armrAlgos are designed to help us defend capital so we can take advantage of these types of collapses and capture alpha. Okay? So what would have to happen to change, the risk monitor back to green? Right now, it seems like a national pastime. Everyone's trying to guess where the bottom is. Let me explain how the ARMR investing way works. We don't guess where a bottom is. We react when the bottom is in. It won't be strange. It won't be confusing. You'll see it right there on the chart, and you probably won't believe it. You'll look at it and say, really? Because there'll be all kinds of horrible news and whatever, and the market will start bottoming. Okay? So our job is to read and react to market behavior, not to guess market behavior. Okay. Now, this has been the most volatile week. It reeks of volatility. It's been the most volatile week in decades. You've got to go back to the financial crisis of 2008, the Asian crisis in 1998. You can go back to the 1930s. Seriously, that day where the market was up 9.5%, there's only been 2 other periods of time where the S&P has had a move like that. It's twice in 2008 and also in the 1930s. Well, the 1930s, there was we're going to take that off the board because that's probably too long ago and the market's changed dramatically. But the 1930s and 2008 are not bullish markets, right? So a lot of people were excited. Woo, market's up 9.5% in a day. The feeling should be not excitement. It should be concern. There's nothing exciting about that unless you're a day trader and you caught it right. Other than that, it's concern. Wild volatility is a paw print of a bear market. And so what we've done with our algos, because that kind of volatility can flip oscillators green, right? Wow, all of a sudden, everything's telling you time to buy the market if you're looking at stochastic, okay? So you can't just look at those things in a static way. The market's dynamic. And so when we wrote these algos and came up with this strategy, we came up with a kill switch. If the S&P is up more than X% during the day, you cannot get a new buy signal in the market. I know that might sound strange to you. Why not? It's a huge day. No, it's because a huge day is part of a bear market. These algos are designed for the fat part of the bell curve. And we allow for volatility, 3 standard deviations around the peak of that bell curve. And when you hear people talk about tail risk, that's where we are now. We're in the tail. We're way past 3 standard deviations around the center of bell curve when it comes to volatility. We're way out on the tails. So you can't execute a strategy designed for a normal market. We'll put that in quotes, whatever normal is, with a reasonable band of deviation. You can't take that strategy and apply it to a market that's in the midst of tail risk. What you have to do is be patient and protect capital. Is it possible I start putting money to work and the market's trading higher than it is today? Absolutely possible. Totally possible. Probable. I bet it's probable. The strategy is not designed to pick a bottom. The strategy is not designed to catch a falling knife. It's designed for the fat part of the bell curve when most of the money is made. That's the key. So what will happen is at some point in here, volatility will compress back into the bell curve and our strategies start working again. But for now, the kill switch is hit. Nothing to do. So macro fund, not buying indexes. We're not using any of this volatility to say maybe the bottom's in. In fact, we say the opposite. Probably the bottom is not in, okay? Here's a chart. There's a chart for you that shows what's going on in the broader market, okay? This is not just, I'm going to read it off to you. The market dropped from like 6,100 to 5,000 and then had like a short bounce. But fewer than 20 stocks remain above the 200-day moving average. Breadth is extremely low, and the 10-day SMA is still sliding. So there's absolutely nothing that's happened this week that would suggest to anybody other than a carnival type of, come into the booth and guess the weight. Okay, I mean, that's the only thing you'd be doing if you're guessing the bottom. You'd be doing like, I feel like the bottom's in, but there's nothing suggesting that yet. And so algorithmic risk management research, you need to manage risk first before you try to capture upside. And right now, the key is to protect capital. I might be buying stocks with you dramatically lower, market could continue to crash, or I might be paying up for it in a couple of weeks. I don't care. Whenever the volatility compresses, that's when we'll start putting money back to work. That's the big picture. All right. So what are we doing? Highlighted stocks of the day has to be precious metals. Okay. This is gold up here, physical gold, physical silver. Let's talk about that in a minute. The gold mining stocks, GDX, GDXJ, they're all blowing out. Okay. Our top names in the Newmont, Franco-Nevada, Royal Gold, Wheaton Precious Metals, okay? Those are the top four. 40% of the innovative growth portfolio are in those four stocks now, okay? 20% of the macro fund are in those four stocks right now. Let me just show you something real quick. This can't continue, okay? This just won't continue. This can't and won't continue. This is gold. The price of gold is skyrocketing at a 45-degree angle. The price of gold's up 50% so far in 2025. Now take a look at GDX. The broad gauge of gold stocks has yet to break out of that pattern. But this week, if we close up here, please notice the massive inside out reversal week. That's the dinner bell ringing on mining stocks. So if you're underinvested on the bullion, I mean, we own bullion, okay? We own Sprott Physical Gold. But if you're feeling underinvested, either you don't own bullion or you own it and you're like, gee, I don't own enough. I submit to you, by the end of 2025, it will be the year remembered for mining stocks. Right now, it's the year for metal. It's up 50%. It's sick. At some point, institutions wake up to the fact that the earnings power is going to go berserk for the mining stocks. And this chart pattern is a weekly pattern. They shook it out this week when the market was crashing. And they're closing the week if we continue. And by the way, they're all gapping up 3-4% right now. If they close up here, you've got a massive inside out reversal week. And you got to have, I'm not telling you what to do. This is not investment advice, blah, blah, blah. Okay. I think we're all hopefully mature enough to know that, but I'll throw that out there. This is what I'm doing, right? 40% of the fund is already there for me. That's the innovative growth. 20% for macro. So I've got max exposure there. And we already have 10% physical gold. So we've got our exposure. So what would I do at the end of today? If we close at the highs with this massive inside out reversal week, I think it's the, you know, it's the word I'm looking for. This will end up, we'll look back and realize, wow, this was the week of ignition. Okay. So I might increase the size of the positions I already own. Probably not in innovative growth. We're already at a large, but I might bump up the size everywhere else, all the portfolios that I run, and probably going to start looking at some of the smaller names again. All right, let's go look at the weekly charts of some of our favorite. SKE, stock hasn't broken out yet. AUST, stock hasn't broken out yet. I mean, now these things are just completely underappreciated right now. And there's Equinox Gold. There's just a couple of names, okay? These are smaller cap in nature, although Equinox is bigger, but most of them are smaller cap. So when do I put money in the small cap names? Well, let's take a look at GDXJ. Okay, GDXJ is not far behind GDX, right? GDX is already blowing out above the all-time high. GDXJ is down here. You could own GDXJ, or I'm probably going to cherry pick our favorite names. Silver Fox is the best at this, so I'm going to cherry pick some of his names, an ARMR analyst, our certified ARMR analyst, and someone I like to call Dad, because he is my dad. Okay, so I'm going to cherry pick, or you can always just go straight with GDXJ, and you can see it's a little bit behind the bigger names. In a market of extreme volatility, probably too dangerous to put a lot of money in small names, okay? So that's why they're going to lag. But it might be worth seeding the portfolio with a reasonable amount of risk. So small positions, and then we can build on it. There might be building blocks I get involved in, all right? So that's the highlighted group. We're already positioned, so we're experiencing a nice rise here, and I might increase that size if the weekly chart, if we have a major weekly inside out week. So I don't know where we're going to end up. In the market, they're all gapping up right now. Well, who knows where they're going to end? But if they end up there, okay. Now let's shift over right before the market opens to my whiteboard of stocks I'd like to own if the market bottoms. I keep watching these stocks. I blew out a whole bunch of my dividend payers, okay. And here's the biggest thing for you guys to watch. You have to watch Treasury bonds. So if you're asking me for how do I judge if we get to a bottom, there's two ways to look at it. One, volatility will compress. You really don't want to see 5% swings on the S&P every day. That's just not a normal market. So we need volatility compressed. And the other thing is we need Treasury bonds to stop collapsing. Okay? This is a pure collapse. So every time people cheer because Donald Trump says something about we're going to have great deals, we're going to cut a great deal, blah, blah, blah. The market's opening right now. There's the bell ring, and I'll talk to you in a minute about how I'm going to day trade, but I don't do that for 15 minutes. So we have a couple minutes here to round out this conversation, okay? Watch this market. There's two things you want to watch for a market bottom. Volatility to compress. That'll take a couple of weeks. So you'll just start to see trading go like this and a tighter range start to build. That's bullish, okay? And the other thing is Treasury bonds. So when you hear about all the excitement, tariff this, and now's a great time to buy the market, says Trump, and the market goes up 9%, and we're going to cut deals, and we're going to delay for 90 days, and there'll be some deals announced, okay? And the market might go up when the deals are announced. Watch the bond market. If equity pops when the deals are announced, that's algo trading, reading news, crawling the news feeds. They crawl the news feeds and they trade when a story hits the tape. That's an algo. So you get wild swings in equities. Watch the bond market. Okay, let me show you what I mean. On the massive up day, well, maybe it's easier to see it here. On the massive up day, okay, here's a 3-minute chart that we're looking at. We have a massive up day in equity. Everyone gets excited because Trump tells everybody to buy the market, blah, 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 okay? There's going to be a suspension of tariffs for everybody but China. And what did equity do? Equity had an insane up day. That's right here. All right, this is the insane up day. Equity goes berserk because of comments about delay. Okay, so equity goes berserk. 9.5%. What did bonds do? This is the correlating day in bonds. Nothing. Bonds did nothing. Bonds are still trapped in the downtrend. So while the equity players are over here breaking out party hats, somebody keeps dumping bonds. Probably China. Probably the trading partners. They're talking one way, hey, we're going to try to figure out whether or not a deal, blah, blah, blah. And dumping of bonds. Stocks follow bonds. They always do. Sometimes it takes a few months for stocks to follow bonds. Other times it takes a couple of hours. I think we're in the time where stocks follow bonds almost within a day, let's say. There could be a day where the market does something other than bonds. But if bonds don't confirm it, equity comes right back down. And that's exactly what's happening right now. So you can simplify what you're doing. You can make this very easy. You don't have to guess if the bottom's in. You'll know. Volatility will compress. The market will get tight for a couple of weeks. And the bond market will stop imploding. I'm not even asking for bonds to go up. We just need bonds to stop imploding. And we don't have that yet. Okay? So, right now, bonds are breaking below this red line I have drawn in here. You can lower it if you want. You can come into here. I tend to put it right there. And the reason I do that, so this is a little lesson on, don't forget, technical analysis is an art, not a science, okay? So everybody could do differently. This is how I like to do it. Whenever there's a gap, that's important to me, okay? So I'm going to draw that line right here because back in 2023, this is like an island reversal. Treasury bonds were testing new lows, and then they gapped above that red line, okay? And so that's the red line I draw across. And then you can see the market here in early this year, 2025, early this year, it tested the red line and gapped back above it, right? So you can see how important that number is. Roughly, let's call it $86 on TLT. To me, that's the line in the sand, the Maginot line, whatever you want to call it, okay? Got to close the week above that. Close the week below it, gapping down below it right now, and close the week below it, and we're in the market's in serious trouble. Okay, so now let's go look at how we're going to carry trade today. So you can see all the action in here. 525 is the key level. I highlighted that yesterday, and the action is still around the 525 number. And the market had a very constructive day yesterday. It broke below 525 twice, and we picked off a couple rallies back up to the 525 level yesterday in the carry portfolio. Okay, so what do we have today? I mean, I generally don't like to trade the first 15 minutes. So I look for the opening range to set up. Oh, by the way, you're looking at a whole bunch of different lines on here, right? So let's just go over it real quick. This is 3-minute bar charts, and then up top here is the 1 minute. So I look at 3 minutes for my direction, 1 minute when I'm executing. All of the lines on here, with the exception of the purple lines, all the other lines are created by the price movement profiler, we call it, the ARMR PMP. It's an algo that draws a bunch of lines, okay? Helps us with locations. We use this for the location, and then we look for the buy trigger. So black dots are the VWAP, standard deviations 1 through 3 above and below. We have an opening range after 15 minutes that creates Fibonacci extensions above and below. And we have the average true range high and low, which is all ARMR infused volatility components. So the ARMR ATR, okay? You'll see the ATR move around a lot. It's not just a static line. It's an average true range that changes based on volatility. Then we have this important ARMR moving average, and we have envelopes, standard deviations 3 above and below. And what I've also done here, you might see it, I've put the Fibonacci extensions on, or retracements, Fibonacci retracements on from the Trump announcement of a 90-day tariff relief, and the market skyrocketed. So we put our Fibonacci retracements, we start at the beginning of that announcement. Okay. Oh, Newmont's up 7%. Oh, wow. We just hit a home run there, didn't we? Peter Rabbit under the fence on that one, boys and girls. This is the week, guys. This is the week. Everyone's waking up to precious metals. That weekly close is going to be so huge if it's up here that I won't mind increasing my position size at the end of the week. I know you're going to think that's crazy, but it's not. You're getting unbelievable relative strength, and money is flowing into the mining stocks now, and that's not going to stop. That's going to get lots of fun. All right, but we don't do that first thing in the morning because there's all kinds of tail risk. You get a big gap up and the whole thing closes down at the end of the day. So we're certainly not putting more money to work on a massive gap up. But what we did yesterday was we were buying, let's see if we have it set up here. Now, what I was doing yesterday was buying after the blowout in the morning on Newmont, for instance. I was buying weakness down to the VWAP. And so we'll look to do that again today. So right in here, this was the time to put capital to work yesterday. It took off in the morning, then it pulled back to test, and that's when we were buying it. And then we added it at the close. So we bought some here and we added it at the close. So I'll be doing the same thing. Let it skyrocket, let it trade, and then see where it settles. I might add some more during the day and add the rest at the close. All right. What did I want to say to you about this? Oh, yeah, we were on Fibonacci retrace. Okay, so from the low of the announcement of a tariff suspension for 90 days up to the top, and then you draw your Fibonacci retracements. And we're trading right in that key range. So everything is right around 525. That's the great location of 525. And we break out above it, I'm going to want to own the market here today, without a doubt. Okay, so we have a tight opening range right at prior day's VWAP, right around the 50% and 61.8% retrace. Okay, with 525 probably being the trigger again. We get above that, we're going to want to be long. If it pulls back, sells off, tests the lows of yesterday, reverses, we're going to want to be long. Comes down to 500, which is definitely possible in this market. That would be the next key location to look for a reversal. But I'm tempted to look for an entry point this morning. Now let's talk about how I'm going to trade. In a normal bell curve, in a normal market, in my carry portfolio, I'm trading triple the S&P, SPXL. And I'll put 100% of my money to work to get triple the upside. And I need that because the average volatility on the S&P is maybe 0.5% during the day. So I'm going to use leverage to give me alpha, okay? Right now, we are so far outside the realm of normalcy when it comes to volatility. I don't want any leverage. So for a while, last week, I dropped down and I was trading twice the performance of the S&P, SSO. I don't even want that in my carry portfolio. And so right now, I did it yesterday and I'm doing it again today. I'm only trading straight S&P, SPY. That's all I'm doing. But think about it also. I want you to work it through this way. I have a I have 100% carry only portfolio. So I typically, when I put a trade on, I put 100% of my money to work. I'm carrying Treasury bills, collecting interest, and I put 100% of my money to work. If I trade triple the S&P, I'm getting 3 times exposure. If I play double the S&P, I'm going to get 200% exposure from market moves. So what I'm doing now is I don't want more than 1-to-1 exposure. I don't need it. The volatility is so enormous. Market's moving 5% a day. I just need to get a trade on. And if I catch a rip, the whole portfolio is up 5%. I mean, I don't need to be greedy here. And of course, the opposite's true. You got to manage risk. It goes the other way. You're getting blown apart. So the other thing I want to suggest right now is, with options getting priced in an extreme way, we're probably getting screwed when we're trying to trade double and triple the indexes. And you can see that through the spreads. The bid and offer goes like this. So you're not really getting the prices you think you're getting when you're trading things that are based on leverage. This is a market not to use leverage. Here's a couple other reasons why. I'll use, let's say, double the performance of the S&P in a normal market because I want to get a swing trade on. So let's say I want 50% exposure to the market. I'll put 25% of my portfolio in SSO. That'll give me 50% exposure to market volatility. S&P goes up 1%. My portfolio is going to be up at least 0.5%. And then what I'm going to do is use 75% of my money to buy individual stocks or make other types of investments. You follow me? In this market, there's no swing trade coming. I'm not going to be using the money for anything else. So I don't need that help. This looks like a barred buy. I got to see where it closes though. I don't need the help of leverage right now to help me make room for other investments. Do you see what I'm saying? The only thing I want to own in my portfolio is the S&P. So I don't need to make room. So that's another reason why I'm not using, let's say, double the S&P. Here's another reason, okay? Other than the bid and offer being screwy on the others. So I get much better execution on SPY than I do on the levered funds right now. Hello? Talk to me. No. Okay. What I'm saying is I'm getting much better execution. The bid and offer is really tight on a $500 stock. And then just, this doesn't matter too much, but because I trade at fractions of a penny a share, but I'm still trading at pennies per share. So if I'm buying a $500 stock, I'm fewer shares. There's just so many reasons right now. That's kind of like a superfluous one, but here's the last one I would tell you. When we're day trading, there is the very real possibility that there's a piece of news hits the tape and the market implodes and we're stuck on a trade. That risk has gone through the roof right now. The last thing you want to do is get stuck on a trade because a piece of news hits the tape and be in a levered fund. So worst case scenario, I get stuck in a trade and I actually all I do is own the S&P. I own the S&P. It's not the end of the world. I can work my way out of that position. You see what I'm saying? But owning leverage at a time where the market implodes. I mean, if you're trading with me, if you're trading on your own, anybody who's day trading right now, you have to recognize that there is a new risk on the table, something that you really haven't thought about before when you're trading in a normal market. And that's like market halted, news pending, gapping down for whatever. We're in that type of market. So if you're putting money to work, no leverage. Just put some money to work and be content with the capital that you capture. Okay, right now we're getting the entry point on the first trade of the day. Let's see how this. Hold on a second. What's this? 947. What bar is this? 48 bar. So I'm going to wait to see where this bar closes. I don't like buying tails, and I don't really want to buy today, but this market open was so tight. I don't like to usually buy in the morning, but this open was so tight at the key location that it makes me want to get a little bit of action on here. And we go below the low of this bar, back below 525, the trade's obviously over. What are bonds doing? I'd like to see bonds stop collapsing. I'll get a little more bullish. Stupid headlines coming across. I love when the market tries to explain. Analysts try to explain why the market's up. It always makes me chuckle. Right now they're saying markets were rallying a bit because the Chinese. Trump said the Chinese should reach out to him. I mean, really? Is that why the market's rallying a bit? Right. So this is the first setup of the day, but it would be a tight stop. So the setup right now that's intriguing to me is a very tight opening range and a pop back above the key location. So comes back below it, the trade's over. We look for something else later in the day. Typically, I like to trade weakness. I don't like to trade the market, the market open on strength. So I have a smaller than normal position size right here. And I'm watching to see what it does. If it's an immediate reversal, obviously out. If it makes a nice tight pennant up here, I might increase the size in a minute.
Order filled.
Okay, so I'm long around 527 and my stop's 525. This is a simple testing of the waters here on a tight really range from yesterday. And I have a slight expectation of strength today. I'm actually looking for some strength today. So I'm leaning that direction right now. I'm looking for strength today. Usually that massive up bar has arrested the decline for now, and I would expect the market to try to get up there and build some type of pattern before rolling over again. But you never know. It depends, I guess, on the headline. Come to think of it, I think the stop has to be a little bit lower than 525. That's right there. 524 is the low. That's the stop. So you have to have a position size that can manage the volatility right here, because like the stop's $3 away, which is totally not normal, right? You guys who trade with me know that, geez, our stop on a normal trade, it wouldn't be $3, it might be 30 cents. On a normal day, it might be 30 cents. Now it's $3. So no leverage, smaller position sizes. Otherwise, you just can't trade this market because you get blown out. You can't let the trade mature. Do you know what I'm saying? So act accordingly. You know, I used that weakness right there. So I put on some usually when it first goes, and then and if it has a down bar, I usually add to it on weakness, which I just did. So I've just bumped it up a little bit. Um, Maybe I increased the size a third, added another whatever size I had on. I bumped it up by 25%, maybe 30%. In theory, I would finish it off if it takes out the high of these bars in here. It's making a consolidation. If it broke out and closed up there, then I'd have the rest of my trade on.
Order filled.
The timing is quite unusual. Drinks coffee at midnight. The moment is not right. Timing is quite unusual. Meet Virginia. Now trade's over, of course.
Order filled.
All right, I'm gonna cut that out quick here at the 10 o'clock break, and we'll see if we want to put the position back out if it holds that stop right there. So I'm out at 526, a little bit below that. I'm going to start over after we see what happens here. It might hold this level. Yeah, so you had to exit that real quick because the volatility is just too extreme. You see what I'm saying? And a small part of me now questions: do I want to flip short? Oh, geez, we've made a lot of money flipping short in this market, but at the same time, you get your head blown off when it goes the other way. So I think I'm going to focus today on really searching for the long trade because that's the kind of the position I'm in. I don't really want to short today. You know, so I'm not putting that trade on right now. When is silver going to catch up, if ever? That's the question. When is silver going to catch up? How much longer could silver be down here? All right, I put the position back on down here, as close to the stop as I could get it, the original stop, remember? And so I just wanted to get out of the way. It went down to the original stop, and I added it back. And we'll see if that trades. That's why I didn't want to go short today. So we're going to call this a continuation of this trade right here. I put it back on right around here. Oh, right in here, about 526. So 520, what's the low of this yellow bar? It looks like, yeah, 524 3/4. So to me, this is like a continuation. I just got out of that trade up there at 526 and change. It dropped down. It never went below the stop on a closing 1 minute, 3 minute basis. The 3 minute basis was right around the VWAP. It held. So when it came back up there, I put that trade right back out. Now, if it violates it again, then the trade's dead. But that's why I didn't want to flip short yet. It's not a market to flip short right now. Now we're looking at all the charts here. S&P, NASDAQ, Dow, small caps. The red line is the high of what is it? Tuesday. Wednesday was the insane up day. And so that price there, 525, that's the key location. And the other red lines are the corresponding key locations. So you can see that the S&P and the NASDAQ are above the key location. The Dow is just popped back above it as well, but small caps are way below it. Small caps tend to follow the bond market. And as you can see, the bond market's just in a straight downtrend. So I'd be more enthusiastic about this setup right here if the bond market was going up. That's interesting, Dave. Overnight futures to help with your morning trades. Interesting. much longer can silver stay down here? Don't you feel like we should have a silver trade back on? And just sprot physical silver to get started. I mean, this is the bottom, and this today is the buy day as it gaps out. I mean, silver is going to join the fray at some point. I feel like putting that trade on, guys. Watching Sprott physical, pretty close.
Order filled.
So that trade is over, and now the question is, do I want to flip short? Now the question is, do I want to flip short? And that answer is a rapidly becoming a yes. So it's a yes on the short side, guys. I'm short right now. I'm short the S&P, but I've got on this down bar right here was the short bar. High of that bar is the stop. So, when you're shorting, it's a wicked tight stop. If it goes the other way, I'm out. And I don't have nearly the size on short that I would do long. So if my, I don't know, long position was 50% of the portfolio, I don't know, maybe I've got 25% short. I'm gonna lower my stops to break even here. I'm not gonna lose money on this entry. But what I am going to do is, if it keeps going lower, then I'm going to carry that. If it comes back to where I shorted it, I'm going to step aside. I mean, this could be a nice bottom right here on the S&P. It's possible it holds right here. So we flipped short real quick, and it went down, bang. It extended another bar, and I'm just going to make sure I'm not losing money short today. How's our silver doing? Silver tends to go down with the market. That's the only problem. So I'm not putting on the silver trade just yet if the market's going to go down. If the market holds, then I'll look to silver. Again, I'm watching the bond market, I'm watching the bond market. If the bond recovers, then I can get a little more bullish today. What is that story? China mulling opening its ETF market to Western market makers. Is that China's answer to the U.S. kicking them out of kicking their companies out of the U.S.? I don't know what that story means really. Hmm. I'm going to take these shorts off right in here. All right, we're all out of the shorts around break even there. I'm going to go back to flat, looking at silver. I might start nibbling arrows. There's an entry point in the market right there too. You can get long the market again. There's a double bottom with a powder keg. If we close up here, you're going to want to be long again here on a carry.
Order filled.
All right, I'm on it there. That little double bottom at the opening range low, which is the 61.8% retrace of the Fibonacci extension. Now, if we break below that, I'll get short again. That flip trade I tried real quick. I took it off at break even because it wasn't extending lower. So I'm looking for the long trade here. That looks like a nice double bottom, little powder keg right at the armor movement, right at the opening range low and the 61.8% retrace. And so I've got a minor position on. Nothing enormous, but I got a piece. All right. I mean, the stop's got to be raised again here. So we're trying to get on a trade today. First trade was a loser. The shorts we covered break even. Now we're trying to get on. We're on this trade here, and we're seeing if it's going to extend, right? And so the stop's got to be, back below these lines right in here, somewhere around 523.5. Let's call it 523-ish. I think 523.50 is just 523 even, with some wiggle room of maybe 30 cents.
Order filled.
So far today, I've added physical silver and AGQ. I've added physical silver to macro fund and AGQ to my innovative growth portfolio. Stops are in here, and I have a position I can build on. So, probably 10 3/4 is where this trade I might take it out. I don't know though. I think the spot physical silver I'm holding, I'm going to hold this and look to either increase the size to max by the end of the day. I got to watch how it trades, but I think there's got to be a unique opportunity here in silver. There's just got to be. I mean, look at what happened to AGQ. If there's ever a time to buy, it's down there. Now, I mean, the other thing I could do is buy the silver stocks. So do I want the silver stocks? I'm toying with the idea of AGQ instead of having to guess about the silver stocks right now. Or instead of having to guess about, I don't know, some of these small cap mining stocks. I mean, I'd like to own, look at that. Ooh, AUST looks really good. That's kind of wild and loose. I don't know about that pattern. AUST looks really good, but I know Skeena is one of our favorites. I like that chart a lot. I don't know. I might cherry pick those. If the bond market could stop going down, I'd love to get back on some of our favorite utility stocks. Man, they can't. They won't even bring down Philip Morris for a second. God, I wanted Philip Morris down here at 131. Here's some top stocks to watch. IBM's holding up right where it should. See how IBM came to the 200-day? I was hoping Philip Morris was going to do that. Damn, I wanted to be on that. Erez mentions Verizon. It got upgraded today. I totally agree. That's at the top of my list. Why isn't it not here? I don't have it here, but it should be on this list because I do want to get back on a Verizon. You know, if I think the market's not imploding, Erez, I'd like to put these trades back on. You know, not trades; they're investments. I mean, I'd like to get these investments back in the dividend portfolio, but um, just can't do that. I just can't do that right now with mass hysteria in the market. I need to see volatility compress, and then I'll go do that. See that this trade's trying to work, and it just can't work if treasuries are about to hit a new low. Damn. I thought we were going to get paid on this. I really did. I really thought that was going to be able to pop out. New low on the bond market. Damn. So I have this position on, we took it off, ran up and then cratered through the stop. I'd like to put it back on. We booked a profit here on ENB up here, and it's come down to the 200-day. I'd like to put that on, although that chart doesn't look very good. Utilities, it's hard to buy utilities with treasuries imploded.
Order filled.
Trade's over. That's going to take me out of that trade. It was a real tight stop. So I'm back. I'm on it here and literally back out right where I was on it. So I'm using almost a break-even stop there, and there's no way around that. I can't sit on these trades today. They have to go, or I don't want them, and I'll try it again later. And then the question is, do you want to flip trade again? What time is it? 11 o'clock? What was that story? Weird. Hmm. What was the story that got that to go? Current rate stance remains appropriate. It's not the story. Boy, man, it's just I don't think you can really flip trade today. It's too hard. Wild swings. Silver at a new high since we started. Look at this, the bond market's imploding. That's the problem. So I took that out at break even. Then it had this weird spike, and I'm sitting here staring at it. A real fight going on at this price point. Bonds are making new lows, though. I got to think the market's going down from here. That's what I think's happening. I'm going to leave flip trading up to you. I may or may not be shorting here, but I don't think anybody should be shorting, to be honest with you. But with the bond market imploding, I don't see how the market's going up. So basically, like the short trade would be back on, but I honestly I don't think anybody should be shorting today. But that reversal right there, it was the tail and then the reverse is what's setting that up as bonds make new lows. So a quick review of our trades today. We have this entry point this morning. It hit a quick stop. Then we had another trade on with a break-even stop. So real tight in here, even though the swings are wild. So position size has to be smaller so you can manage the risk. But there's a lot of chop in here and no direction at the moment. Then I had a short trade on earlier that I took off at break even. It rallied back up in here, and there could be a flip trade short again. And that would be just keying off of what's going on in bonds. I mean, if bonds keep going down, I just, you know, I imagine the market's going lower. So we talk about, you know, some of the stocks at the top of my whiteboard. There's a bunch of dividend stocks I want to get back into the portfolio, but it's hard to gauge those stocks if the long bond keeps collapsing. So, you know, I'm not putting those, you know, positions in the portfolio. trying something a little new right here. Some shorts out, and I've got some long positions out. I'm going to see if I can manage both sides of it. This is the place to buy the S&P right here if it holds this level. Breaks down from this level, obviously you don't want it. So I might be long S&P, short small caps down the NASDAQ against it, and see where's the move where they get going. I'm going to see if this works today. Boy, NVIDIA looks good here on the 3-minute chart. NVIDIA, MicroStrategy, they're popping up a little bit. Those are my favorite places to look short. They're looking a little bit longer right here. Boy, it's like the market's just kind of gone dead quiet. That theoretically should be good for the long side, not the short side. No sooner do I say that does the market come down, but just stuck in a really tight range. And you know, the longer you're stuck in a tight range, the more that favors puts, you know, getting sold into the weekend and a rally that tries to build on, you know, the 9.5% up day. So if this is going to break, it's got to start getting busy. That quote good looking setup on NVIDIA and MicroStrategy are rolling over right now. You can see this is it here on the NASDAQ. It really, really has to hold this level, which is that key location I was talking about from Insanity Day. It's the equivalent to 525 on the S&P. This level is about 443. here we are approaching the key time of day too, which is 11:30. And so, 10:30, 11:30, we made a 10:30 bottom and we're working on an 11:30 bottom. This is either going to hold and break out, or this is going to fail at 11:30 and break down. And that's what I think is cooking right here. I've kind of matched off my portfolio. I get long the S&P and I get short the other indexes. I am net short right now, but not in an aggressive way. If the S&P breaks down, then I'll be aggressively short by simply taking off my long S&P position. If it goes the other way, then I'm going to increase my S&P position first and see where it takes us, and then unwind my short trades. The 11:30 update. So the 11:30 update. There's no real. I'm trying something a little different than I normally do. So I'm long and short at the same time right now, and I'll tell you how that works by the end of the day. But this certainly looks like a long setup, and probably the last long setup of the day right here. It's either going to work or the market's in big trouble. And so, you would expect the market to be able to rally today after this insane week. I think if Treasury bonds can come off of the lows, then we might see the market be able to rally into the close. So this location right here makes a lot of sense to me. We'll see if it works. Here, I'll show you the double bottom right in there again. So look, if you take out that level, it's over. But if it holds from here, this would be another type of powder keg setup. And I don't, you probably don't want to be short today. That's kind of the feeling I've got. You don't have to go long either, but boy, the last time we had a tight day like this was 2 days ago. And a piece of news hit the tape, and the thing was up huge. So I don't know, something. Either don't trade at all today, or I think a long position one more time right in here at 11:30. But real tight, you got to get it real tight to the base so that you're not putting out too much risk. Too far away from the stop. Bonds are back above the VWAP. That's got to be bullish. I've added a physical silver position to the portfolio. There's the island. This is the gap up. So this is an island reversal below the 200-day moving average and back above it. So I've got my silver play on. And of course, a piece of the silver play. So I got to see where it ends the day, and I'll finish the position off. I'm toying with the idea of owning AGQ instead of the silver stocks. I may want to go that route. So then I'll just get twice the performance of silver, and I don't have to worry about which silver stock's going to go up. Of course, considering adding a little bit more to my best positions by the end of the day, I've got a little bit of room to bump it up. I don't know, 25% maybe, to finish it off at the end of the week. I just wanted to see the weekly close. This is a massive inside-out reversal week. So if it closes there, then I'm going to want to have my max position on. I don't see myself getting out of the seat to have lunch, but I might jump out just to grab something and come right back. But right now I'm just watching these positions and waiting. I do think that how tight this is becoming is making it more and more bullish today. So we'll see. My theory behind being long and short is I want my full position on the S&P. And then what I want to do right down here at the 1130, that bar right there, I want my full position on the S&P. But I may not want 100% exposure just on the long side. So carrying a Q or a small cap or a Dow short against it, and then I'll release the full power of my position if we actually break to the upside here. I think maybe small caps is the best way to hedge it. I might want to be long the S&P and short small cap. That might be my best choice. Hello? Hi. So I'm net long right here, near the, not too far away from the low of the day there, that nice double bottom at the opening range low. And I have so I'm net long right now, but I've got a short position against it in the small caps at the moment. And so I've just got to figure out how I want to manage that position. I may take it off, and then, if I'm just going to manage that side of the equation. And so if the market starts to run in here, I'll already have my long position on. That's kind of how, and I'll have a max long position on, because right now it's hedged. Do you see what I'm saying? U.S. Ukraine to reopen talks on mineral deal. That story hit the tape. Not sure anybody cares about that anymore, but there it is. The S&P is up right now. Small caps are still down 1%. So that might be the best way for me to be able to put on a big cap trade when I think I need to, and then just manage the risk using small caps. That may be what I do. Doing it right now, and it's working right now. Things are starting to move a little bit higher in here, and so I can always take off that short and then just go ahead and put that short back out if I feel like I need it. You see what I'm saying? So then I have full 100% exposure to the S&P right near the lows of the day. Sure, I took a little bit of a loss in the small cap, but that's worth it for the exposure right now if this keeps running. So Dad's sharing with us that spot physical silver has a 4% discount to NAV right now. That's crazy. God Almighty, what a blowout that is on a weekly. That's the dinner bell. I mean, that's the beginning of something huge right there. Wow. God, silver's down here. This got to be right. This has got to be right. It's got to be right, Dad. It's got to be right. TLT is breaking out in here. That's a good sign. We needed that in a big way. Newmont's up 8% now. God Almighty, what a move! We're just crushing it in this group right now. Hi ho, silver. There's the double bottom, although it's ugly. There's your double bottom in SILJ. I mean, I think I go after SILJ again. Man, this thing should snap back so fast, people's heads are going to spin. Innovative growth could be long. SILJ and AGQ to cover my silver bases in, Armor Macro, long Sprott physical gold. That's what I may be doing today. Hey, good morning, guys. I just checked the comments. Oops. All right. So, those of you who are watching on YouTube and sharing comments, totally forgot about it. So let's go run through the comments from this morning you guys were sharing with me. Around 10:15, NASDAQ holding above key levels. I'm hoping UVXY to break below. That's KC. KC, how you doing, man? Nice to see you. Sold puts here on the big down bar. Selling puts. I like that idea. Mom chill. Ooh, you shorted Alibaba at the open. Yeah, I totally agree with you, Hart. KC, I'd like to see I'd like to see, treasuries be able to break out to the upside today and honestly break this downtrend all week. That would be wildly bullish for the market, because this is telling us what's really happening in the trade war, not all the bullshit you hear on X. Treasuries are telling us, look, treasury bonds are telling us what's really happening in the trade war. All the stuff you hear, all the noise on X and stock twits and all that stuff, that's all bullshit. Treasury bonds are telling you what's happening. And as long as treasury bonds are in this steep decline, the war is on. And it's tough to get bullish the market. If we see treasuries pop like this, I would say somebody knows something in the treasury market and they're loading up, and that would be very bullish for the market. And I would be much more inclined. Like right now, I'm on a very big carry trade right now because I've done something a little different. I loaded up down there at the opening range low, and I went short against its small caps. Not 1-to-1, but I put a full position on the S&P near the opening range low, and then I hedged part of it to make it more reasonable in case things imploded. I would be able to get off of one side and carry the short down into some type of Armageddon thing, okay? And if treasury bonds start to go like this and the market breaks out of this tight range that's in on the upside, what I'll be doing is covering that short, and which will release even more. Like I'm already, like I'm net long, okay? So I'm making money up here, but I'll just release the rest of that position if small caps can get above the VWAP, which they're not doing right now, okay? So far, this is just trading in a range, and I've got nothing to do here. I'm just carrying this position. But I'm in an interesting situation now. I could book some profits up here and reduce my long trade. I haven't reduced the short. I'm not taking the short off. I don't know if you can see this. So let's go over to a bigger chart. I'm not going to take the short off, okay, unless we take out the VWAP on the upside. Okay, it goes bang, I'll cover the short, which will just mean that I'm even more long, right? Because I'm already net long. But pops through here, then I'll have my full long position. I'll be long only. And I'll watch. I'm not going to mess with the S&P. I'm going to let that go. If it breaks out and starts running, this is an interesting. I've never done this before, but I'll let you know how it goes. But one of the objects of doing this is, let's say the market goes and has a stick like this, and I'm covering the rest, the short side, and the thing starts to go. I've got a max long position on at the low of the day. I would have never put that size on if I wasn't hedging it. Like I wouldn't be able to stand the volatility, so I couldn't put the size on. So I was trying to figure out, how do I get the size on at the location I want, but manage the risk. And so I'm long S&P, short small caps right now. S&P's been the strongest index. Small caps have been the weakest index. Small caps are following treasury bonds, which is like almost in lockstep. So if treasury bonds break out, small caps are going to go like this. The whole market's going to be flying. I'll cover the rest of my short, and I'll have worked into a maximum long position near the low of the day, which was something I was struggling doing down there. So so far so good. We'll see what happens here. Now if it rolls over, and I'm in a position now to book some gains up here. I don't need to carry max right now. I'm considering that right now. I'm watching this real close. If it takes out the low of 2 bars ago, which is one of my favorite stops when I'm on a day trade, the low of 2 bars ago is the first time I look to book a gain. I might cut my exposure on the S&P down 30% from 100% exposure, and then I'd be carrying 70% exposure, which would still be enormous if the market skyrockets. That'd be more than enough, and I would have cauterized my risk here, right? Then let's say this thing comes down and I'm taking out the rest of the position. Obviously, it'll be profitable, no matter, unless it's like a huge down bar, it'll be profitable. So if this thing starts to break down, I'm going to book the profits on the long side, and I'm going to still be short. And I'm going to be trading both sides and see. So far, it's working phenomenally well. We'll see how it how it ends up at the end of the day, I'll let you guys know. But anyway, going back to, so Casey's talking about, treasuries, and I really need to see them break this, downtrend. That would just be huge. Looks like a possible double bottom is forming. Yeah, I'm with you on that. I'm just starring the ones. Ivy, are you guys still out there? I mean, you guys wrote this earlier today, and I totally missed it. So if you're out there, I'm talking to you. If not, I'm talking to the wind. TLT IWN reject. Nice to see you, Ivy. Yeah, Philip Morris, just incredible chart. All right, I'm off. I'm not short at all right now. So I got max long position, not short. And if this comes back through, if small caps come back through the VWAP, I'll have to put the short back out. And I'm still watching the S&P now, for the low of 2 bars ago. Takes out the low of 2 bars ago, and I'm going to book some profit on this. That's somewhere right there. So you were looking at Philip Morris with me. Yeah, that looked great. Mom chill, silver breaking which way? Out, breaking out. What's that little creature? I can't see what that. Taking a look here. What is that? I don't know. Is it a silver monster, Mom chill? I don't know what that is. All right, they popped 3 points out of nowhere. Yeah, so true, Ivy. So true, and that's why I decided to get long and then short against it, so I could deal with that. Third-year giving some follow through on the downside. I just caught up to you guys. Great, Ivy. You guys are with me. Great. Bond market is our North Star at the moment. That's right. That's right. Okay, low at 2 bars ago. So far, just to give you a heads up on how my trading's going today, it was a chop day, and I was getting chopped up, and then I put on that trade, and I'm having a profitable day trading. So starting to turn a profit, So, this might really work for us in the chop market, guys. This is, out of adversity comes all kinds of new, great, trading in life in general, right? You have adversity, you deal with the adversity. You have to, you learn things as you go. You build your strategy, keep working on your strategy. And out of all this insanity might come a very interesting strategy for me when it comes to carry trading. Because one of my weaknesses, to be completely honest with you guys, which I like to do, this is my live trading desk. I share with you everything I'm doing. I get excited when I'm making a lot of money, and you can see that. But at the same time, I like to share with you when I'm struggling, so we can learn together. I like for you guys to learn off my own. Like, it makes me feel better if I've learned something, I've lost a little bit of money on something, I've learned something, I want to share it with you. It makes me feel better about the whole thing, like the whole experience, so that you guys can skip that mistake and do better than me. That's what I love. I'll be honest with you. So in this chop market the last 2 weeks, it's been difficult to put trades on. So there's number one, the argument is don't trade because we're outside the bell curve of what our trading strategy is designed for. Number two, you can trade a lot smaller so that you could deal with the fact we're outside the bell curve, but still try to trade. I've missed some massive up moves by booking profits too fast in the last 2 weeks because I'm following the strategy I normally follow. When that stop gets hit, I book a profit. On the one hand, you could say, well, I didn't know the story would come out 9 minutes later and the market would skyrocket. But that's true. But I'm always trying to get better as a trader, right? And so for those of you who've been trading with me for a long time, it does happen a lot because I like to get the cream off the top when I trade. And so I like to book my gains and I walk away and say, hey, I had a nice day. But there's a bunch of days out there, but then it skyrockets and I'm going, boy, how could I have made more money, right? We're all asking that question. And I think something we're finding out about the market right now, because of the extreme volatility, it's forced me to do this. And I think it's going to spill over and make my other trading in normal environments even better. And that's to say, when I'm on a long trade and it's working, and maybe it has that couple bars down that normally would take me out of my whole position, what I may want to try to do in future, we're going to see how this plays out. So this is just the beginning of an idea, and I'm sharing it with you guys. But instead of disrupting what is a really good long position in the S&P, just shorting a different index against it to hedge at a certain time and giving the S&P trade a wider trading range. So if it ends up hitting that wider range, I'm getting stopped out, and of course I'm making money short, right? So I've hedged it, I've booked it, right? And now I let the whole turn happen. I end up booking my profits in the S&P as the market starts to go like this, and I'm still short, and I might play that short trade. What I've done with you guys before is called the flip trade, right? We flip trade. So when we put a carry trade on long and it doesn't work, we get stopped out, we immediately short, bang, it drops, and we make whatever money we lost, we make back in the next 15 to 30 minutes when the flip trade's working, right? And I only flip trade in a risk monitor red market. So we've been red since the 21st of February. That's the time to flip trade. And that flip trade's been working. But what I submit to you is when we get up to certain levels, certain targets, the market looks like it's starting to falter. You know what I'm talking about. It puts in a couple of bars that look kind of weird or whatever. That may be a time to put out the hedge. And by the time we get stopped out, we're already short, bang, like that. And then you don't disrupt the S&P trade so soon. You let it stay out there a little bit. And we know that statistically in a normal market, that's really going to help us because most of the time the market's going up. So if you got weakness during the day, I'm talking about a normal market now, not just this crazy one, but in a normal bell curve, normal volatility market, one of our favorite trades, the market sells off, we get our trigger at a key location, put a trade on, right? And then there could be a lot of volatility along the way, and at the end of the day, market's up a lot. And sometimes that volatility gets me off of my trade. And I book a profit. That's okay. I got off the trade, I book a profit. And then it keeps going higher. And so what I'm saying is, having done it today and it's really working for me, I think I'm going to start working this idea into my everyday trading. Giving my S&P trade more room, but when I'm uncomfortable based on stops that are necessarily getting hit, putting out the short trade. And just for 15 or 30 minutes or however long, like hedge myself. If I need to, I'll end up being short. If it turns out just to be one of these wiggles and it starts to go the other way, take the short off, let it go. And you haven't disrupted that trade. That's something I'm working on. So I'll get back to you as I go. All right, KC, I'm seeing a stealth, slightly bullish structure forming after Wednesday's major move. Traders market, so great to flip long or short at a moment's notice. Yeah. I'm expecting some vol crush to close out the week. That is 100% true. And that always makes me nervous when everybody that I know, you and I, Casey, we're all looking for the puts to get dumped in the afternoon, right? If it doesn't happen, But I totally agree with you. I think that not only should it happen, and it normally does after a crazy week, because vol is going to get crushed over the weekend, right? I mean, crushed. I mean, the volatility on the decay on puts is faster than the decay on calls, and that's why look at Newmont streaking to new highs. Newmont right now at up $9 today. Wow. Oh, that feels good. Boy, did we get that trade right. Newmont today reminds me of Frank the Tank in Old School. That's what Newmont's doing. It's streaking. It's streaking. It doesn't know who's around it. It's just running. Okay. See what I'm talking about on this trading here. Okay. I don't really want to let go of the position yet. If it takes out the low of 2 bars ago, I'm going to cut it down. But what I would do see is before I let go of the whole position because it's wiggling, I'm going to put my short back out on small caps and see how it goes, right? So I'll cut this position down if it takes out the low of 2 bars ago to make some money today because we bought the low of the day and we're selling at the high of the day. That's always a good targeted location to book some profits. And then to protect the rest of the position, I'll get short small caps to see if the whole thing starts to implode. Then obviously my P&L flips. I'll be giving back here, but then I'll book gains on this trade because it's a profitable day. But I'll end up already being short as the thing's imploding. And if it keeps walking up, then I leave it alone. Did I get it? I think I did. Got these little teeny gnats in my office, and they're driving me crazy. Now, it's true, I've killed most of them, but there's more to go. All right. We're watching yields. That's the key to this whole thing. In case you guys missed my morning meeting, there's 2 key things about this market to understand when the bottom starts to really form. Volatility will compress. Treasury bonds will recover. That's what I'm looking for to get more bullish. Okay. You could say that volatility is compressing today. This is a very tight trading range today. That's great. I want a long trade. That's wonderful, but I almost hope it doesn't skyrocket. Okay. I just give me a quiet day of trading. Let the volatility compress and let this kind of build some type of a pennant formation. And then we can get on something that lasts a little longer. But obviously we're on a long trade here, so I won't be upset if it skyrockets. Yeah. My son right now, when Ivy writes, it could be massive. My son would right now, I can hear him. He's 11. He would pipe up and say, "You know what else is massive? The low taper fade." Does anybody know what I'm talking about? Or is that just me? Yeah, Stephen talks about how we used to use dust to hedge our precious metals position. Yeah, I mean, that's a good point, Stephen. Like part of the hedging process, it allows you to put on max exposure of your investment direction. Like, what do you want to happen? What do you think is going to happen? And then just manage the hedge from day to day if you feel like you need it. I mean, you have overnight risk, but manage the hedge day to day if you feel like you need it. That is what I'm talking about. We did that on precious metals, and I'm talking about doing that on the market, I mean, the simple fact is I'd never have on the size that I have on right now, right off the double bottom low of the day. I would never have that size on without the short side. And the short side really didn't lose me a lot of money. I mean, when I put the long position on, and right in here, you know, right in here, I put the that. Let me do this, because I was putting, but right in here I put the short out. So I put the really big long position on, and at the end of that bar I put the short out to cut my long position by about 30%. Okay, and then I covered this right here, and I've unlocked the full power of the long side. And so I got this full position on, right? That was pretty tight right there. And now I've got the full position on the long side, and you know, that's really working for me right now. So we'll see. Now, right now, I'm looking to take out the low 2 bars ago, and I'm going to book some profit on that. So that looks like 527.45. Dad's talking about the #1 destination for institutions on silver is going to be Pan American. And for me, I'm just choosing SILJ. I just don't want individual stock risk in here. I just want the whole group. I've gone through it. SILJ's got enough of everything that I like. Patterns are kind of similar, so I'm just going to go off of that one. And it has a big slug of Pan American in it. Woman is not right. I don't know why that song is in my head. It certainly is, though. Here goes bonds. Bonds are running. See, I think bonds will start running if there's a precursor to a trade deal announcement, some story. Bonds break the downtrend. That's going to get more bullish to me. Market's been walking up this, and right now it's taking out the low of 2 bars ago. So I'm going to book some of my gain there. I'm going to highlight that in yellow. That's where I booked. So I bought some in the green box, and I'm just booked some in the yellow. And this time around, I booked about 30%. I took 30% off right there. a close below the VWAP, and I'll be short small caps again. Markets are starting to follow the bond market. This is good. This is real good. Oh, we're on a monster carry trade now, right? Maybe. We'll see. Right up to the armor moving average. This is the key level. We'll raise our stops on the whole thing up to that 2-bar reversal where we sold some of our positions. So we booked about a third of our gain up there, and now we've got 2/3 we're running with. Well, really 70-30. That's what's that low right there? 526.41. Here we go. Over the armor moving average now. We're having a big day. This has got to be the location for silver. I mean, I don't know if it's going to work, but I know the reward to risk is absolutely ideal right here. Has to be. This is the proverbial now or never moment in silver and silver stocks. What's the silver gold ratio? 100 to 1, something absolutely insane. Silver will rip if the market actually turns.
Order filled. This is the target for today's normal move. I mean, a normal move is the ATR high of the day. So we're looking at a target up there where I would raise stops and get more aggressive on booking the gain for the day. You're on it, Casey. You're on it. So Ivy's saying that the move in the bond market's relentless. And what I submit to you is it's relentless because there's going to be a trade deal announced either today or over the weekend with some of our trading partners. And the market's going to love that. And the bond market's going to go up on that. Do you know what I'm saying? If the bond market goes up on that, I mean, I guess I'll love it too. I'll start to believe a little bit. But the bond market's got to break the downtrend. And right now, Ivy, it's just running right back to the downtrend. So it gets up there and then it rolls back or breaks down. All we did was capture a good trade from the low of the day to the high of the day, which is great. I mean, that's what carry trading is all about. But if it breaks out of that downtrend so that we end the week breaking the downtrend on bonds, that would be, I would think, really important. That would be really important. And I'm going to go out on a limb here and say that if bonds do that, if bonds break the downtrend going into the weekend, I might hold some of this carry trade overnight. Because that's literally going to be a signal to me that there's some other, there's some changes that are going to occur here. Some good news is coming. See, your confidence is tragic, but her intuition magic. We got to break that trend line. I'm going to be right back, guys. What a solid move in bonds here. That's big. So we went below that key red line. We're going to close back above it if we go all day here. I don't know what to make of this, but here it is. If the S&P closes at 5335, so where's it at now? 5335 right now. This will be the best week in 18 months. Weekly close. It would be the best week in 18 months. And the question that the writer on X asked is, does it feel like that? Wow. What does that mean, though? What does that mean? So what did you say? KC is buying some Tesla. You're using leverage. I mean, I don't use leverage in this market. I think that's personally not the right risk reward for me in this market. I don't want leverage, but Tesla down here, certainly is an interesting idea. Here are some of my favorite technology stocks. I think IBM has been just a phenomenal stock in a terrible market. Wow, that's perfect.
I'm back in a second.
All right, we got some resistance right here. Went right up to the downtrend and backed off. Market is following suit. Never quite got to my target. Coming down below this key level right here. So I think some more profits to be booked would be wise. And perhaps the short trade again. Okay, so now I've got and I'm going to put on a short position there in small caps right there, because normally what I would do is probably sell out of my whole S&P position here. So I'm going to just try something a little bit different. I've booked half my gain on my S&P trade. This never got to the target. I'm going to leave that out there though until this trade's over. And so right on this bar, I'm going to book some of my gain. I'm not going to take the whole thing out though. What I'm going to do is just reduce my overall long exposure a bit by being short small caps right there. So now I'm still net long, but a little bit less so, carrying a little bit of a short position. I want to see how this plays out here. And still, so I'm still long the S&P. I'm still net long the S&P. This S&P trade really doesn't end until we, wait, this is not an ending bar. I just booked a profit. That's yellow. So this trade doesn't end until we really take out this location here, and then I'll exit my S&P trade. So that's going to be there. Okay, that's the targeted exit, probably somewhere right around there. Let's go look at the gas goats. I gotta be honest, Ayers, the gas goats held up real well. I mean, AR didn't. That guy, that's ass handed to it. Ooh, RRC didn't. How did LNG hold up? LNG held up pretty well. This is the pipeline, situation for me. That KMI down there, AMLP. Dad's highlighting Nova Gold today, NG. Nice double bottom there, maybe. Silver Fox is thinking that Barrett Gold is going to take over Nova Gold before this whole gold move is over. And there's a nice double bottom entry point. June calls, Dad's buying for 10 cents. Woo! I like that idea. Bottom right part of the screen, this is the problem right now. That's the problem. Let's see if equities follow. Yeah, that looks like a nice reversal right there. We'll see. So whatever I put out short right there obviously is covered right here, and that allows me to stay long the rest of my position. So this came down and wiggled, didn't stop me out. Now I'm still long on that position. I could even increase the size at that point. That's a perfect reversal. This is beautiful. What a move.
All right. That's such a bullshit story, Fitz. No, I mean, seriously, Fitz, that's such a bullshit story. The Financial Times reports a source. The Fed's ready to support the market if it needs to. I mean, I'm not, by the way, I'm not giving you a hard time, Fitz. I'm saying that story is bullshit. I can't tell you how many times I read that story in 2008. I mean, it's just total bullshit. And it's a great way to goose the market. Hey, look, I'm long right now and I'm making a killing on the carry trade. So it's lots of fun. And I'm glad somebody posted that in the Financial Times. But it's just ridiculous, right? It's just ridiculous. And if it had any merit, if it had Brian, Brian, you knew I was coming. You knew I was coming with that one. But I mean, look, Brian, you were there in 2008. How many times did you hear that story? Shoot, Ben Bernanke would come out in the middle of 2008. Nothing wrong with the financial system. We're here to support the financial system. Financial system is healthy. But bang, but bang, but bang. And every time he would say it, the market would pop for a day, maybe a week, right back down. We had 4 risk monitor greens in 2008. And I don't know this for a fact, but I can almost guarantee you that each one coincided with Ben Bernanke saying nothing wrong with the market and we're here to support the market. And then the market would go up for a week and we'd get risk monitor green. And by the end of the week, it would be rolling over, risk monitor red, crash into the next level. So, and the Financial Times, man, they've been caught lying more times, than a 4-year-old. I mean, just forget it. I mean, it's just the whole thing is just amusing to me. And look, I love it. I'm long. I mean, I hope Financial Times writes some more bullshit stories between now and the close. Make me even more money, But that's just ridiculous. And if it was true at all, the bond market would be breaking out. The Treasury bonds would be going up. We're here to stabilize the market. You know where I put that one, Brian OG? I put that story right next to the story that the Japanese won't sell Treasury bonds just because of tariff issues. So they're going to be selling it for other reasons, not just because of tariff issues. They're going to be selling bonds because of tariff issues and other reasons. Do you know what I'm saying? Wow, I just love that one. Fed President Susan Collins said it. Oh, okay. Look, Fitz, we're not laughing at you, right? I know Fitz understands that. I just, in case anybody's listening, I'm laughing at the story. I'm glad you're posting it and, the market's, walking up on the story. But I'll tell you what, Fitz, if bonds break down from here, look at the 3-bar reversal, not reversal, but the 3 black bar up, bang, bang, bang. You know how much I love that signal. And by the way, we just went through my target. We just went through the target, right? So in theory, I should be booking some more there. You didn't post it? Who posted it? Oh, I'm talking to Chicago Dave. Yeah, Chicago Dave. Look, I should be booking some profits right there. Hold on a second. I got to get some money off the table. Okay. So I just booked a little bit. I always book some at the target, which is the ATR high of the day. Fitz, my mistake, brother. You were saying that Bitcoin loved the story. That's what your post was. Bitcoin loved the story. Right. So Chicago Dave. Susan Collins said it. Okay. It was worth the post just. All right, Dave. All right. I just profited from it. Oh, we're having fun here. All right. So I just booked a little bit of profit right up there at my target. And I'm going to tell you a secret here is I'm working on this trading strategy of hedging against positions. So I put my hedges out right at that level, and I had a 50% exposure to the market. So I booked half my gain on the carry trade, had 50% exposure still on, and went short the other indexes to reduce my long exposure to about 25%. So I was still net long, but I just reduced it, and it allowed me to hold on to the S&P position. As soon as those stops got tripped, I loaded up on the S&P again. Bang, 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 up to my target. Now I'm taking off some of that position again. So what I like about the hedging part is it allows me to stay with my core position, and it allows me to trade around that core. If the stops get tripped, that tells me the market's going up. So it makes it easier for me to put the trade back on. Low rips higher, book a profit, still have a core position on. That's the way I'm trading right now. I really like this. This is freeing me up to stay with a trade in a pretty compelling way. This is really, I'm really enjoying this. And so is my P&L. So we're executing like a real hedge fund today. Okay. All right, you got me all hot and bothered. You really did. So let's go back to, oh, wait, I wanted to just share. So what's my trading philosophy now on this 3 black bars at the end of a move? If we get 3 black bars at the beginning of a move, so in other words, the market sells off, and then goes black, black, black like that, that usually is the start of a big up move. When it does it here after we're already up big on the day, that's usually the end of the move. And so if we take out the low of the 3rd black bar, I'm gonna be done trading, I think, today. I don't know if I'm gonna go short again. I think I might just be happy to book that gain, which is gonna be 533 is the new location. Oh my, I was baited. Okay, stops around 533-ish. Whew, book some more profit at the target that we finally reached. So you're going to hold a long position into next week if the market can recover here. Most importantly, Treasury bonds. I would hold an S&P position over the weekend if bonds close above the downtrend. If they don't, I'm not. And I'm not even sure that makes sense. But it does. Why would we do it? Because there's going to be some positive tariff news that's announced over the weekend. Market gaps up on Monday. I don't know. I mean, that's just. I got to think that through because that's not really an investing strategy. That's just rolling the dice. Let's hope something happens over the weekend, and it can be the number that you bet on, or it could be it could be 7 and everybody gets wiped out, and the dice goes to the next player. I mean, it's just that's not a investing strategy to me. Why are you cautious? We're cautious with Kevin. or KC, you're cautiously optimistic and bullish in the next week. Why? I mean, if you could condense that into a thought, why? Other than the fact that we had a massive up day because maybe there's going to be tariff relief, which there isn't. It's just a 90-day delay while they're working on tariff deals. Like, how fast is a tariff deal going to happen? What deal are we going to hear about this weekend? Israel cut a deal. Vietnam is in the process of cutting a deal. Would that put the market up dramatically? What the market cares about is what Japan and China is doing, and the European Union are doing. These are the real markets. So I'm just curious, base case scenario. Over the weekend, a couple of countries in the U.S. announced trade deals, and there's a lot of fanfare, and the market gaps up on that. I guess I would be looking to short that. You know what I'm saying? Okay, what's the flip side? It takes longer to cut deals. Nothing's going to happen this weekend. It's a 90-day delay so they can sit down and start working out trade deals. Like, how fast does that happen? So nothing happens over the weekend, and China and whomever ratchet up their rhetoric, and the market gaps down on Monday morning. Like, what makes us feel bullish? I don't know. Other than now, I'm going to give a nod to Brian OG's philosophy of his long-term mutual fund clients, right? Guys that he invests over a long period of time for. They own mutual funds. And so if you wanted to argue this point with me, I would listen, and I would have to really, really think it through. It's something, Brian, that I've been thinking about ever since you posted that comment. So I appreciate you posting the comment because it's so outside of what I normally do, but it makes me think. And of course, I manage money like you do. So, my question is, how often does the market drop 10%? I can't remember what it is, like 52 times in 50 years or something, or I don't know what the number is. And some portion of that 10% drop, it drops 20%. You have a bear market, but it's like a small portion. And so there's a theory. Don't quote me on those numbers. Somebody probably has the numbers. You can put them in the room for me. Grok will tell us, and so you can argue that if you've got boatloads of cash, which we do, we raised massive amounts of cash right near the top. So at what point is the market down percentage-wise enough to put on a position, not the full position, but a position? I toy with this idea all the time when the market crashes and I have tons of alpha because I have lots of cash. I sit here and toy with this discussion. I got to watch this here. If we take out this level, I think this trade's done for the day. It went right to my target. 533. 533 is the number. I'll be done trading for the day at 533. Not a bad thing. I got guests coming to the house. This is going to get me. That was a great day of trading. I'm not going to wait. It could be a tail, and I'm going to watch this trade and see, should I have just shorted again? Maybe I should have. Maybe I should have just put the short out again. But I don't want to be doing that all day, every day. What I'm really trying to do is how to make money on a carry trade in a tough day. I just did it, and it was a tough day, and there's a lot of this kind of stuff. And then we made a lot of money on that trade. And along the way, I put out some short positions to hedge myself so I could keep on that trade. But once I've hit the target, this is my primary target for my entry point here, my trade's done for the day. Oh, we'd love to have you, Ivy. We'd love to have you. You'd be a great addition to this desk. One thing I could have done was stay with that trade here, okay? And instead of selling it, I could have just gone and shorted again. But what I submit to you is I'm not going to be greedy today. I just had a great trade right there. That was a monster trade, and it hit my stop intra bar. Okay, I know it could be a perfect reversal, skyrocket again type of day. It's possible, but I just made the white meat right there. That was just gorgeous. So that's a little dark meat too, I think. And so I'm gonna step aside there and say that was a great trading day. Thanks for playing. That was just great. It was great. Hey, thanks again. Thanks a lot, Rhonda. You have a great weekend too. I'm gonna watch now. Oops. Oops. All right, so we know we're all out. The trade's over. That was great. Had a great day. Apparently, Rhonda had a great day, and she's gone for the weekend. Good for you. And I may in future turn around to be short, but I think I'm just trying to use a hedging strategy to maximize my gain on a long carry trade. And then when I get to that level, then I'm done. So let's don't get carried away with constantly trading, being short, being long, being short. I'm only doing that so I could max out my long exposure today, and it really worked. I appreciate that, Ivy. And so let's talk about positioning now into the close. Geez, Sprott Physical Gold's got a 4% discount, and it's only up 2%, 2.5%, 2.4% today, with SLV up 3.5%. Come on, that's not right. So getting back to that conversation with Brian OG. So if you think of Brian's idea as a statistical idea, like he's playing the statistics, there are only going to be a handful of times when the market drops like this quickly. And so he's already started feeding in to that position. And I'm thinking to myself, at some point, I don't know if it's 10% down on the S&P, but maybe it's 20%. If the S&P is down 20%, and I think to myself, what S&P position do I want in the portfolios that I'm managing the next time the armrAlgo gives me a buy trigger? Next time we get risk monitor green, what size do I want? So let's pretend I want, let's just start small. Let's say I want 25% of my capital in the S&P off of the bottom and the market crashes and off of the bottom. 25%, just, you know, 25% position. So, do I start with 20% of that? I just put 5% in everybody's portfolio. When the market's down X percent, they get 5%. Then the market drops and it's down 30%. Now they get 10%. You see what I'm saying? Market drops 50%. I've averaged in on the way down into a 25% S&P position. My alpha is still phenomenal. We're losing some money on that, but wildly blowing away the market, right? Because the market's crashing, but we're layering in. And then when the risk monitor goes green or we get a buy trigger, double the position. Now I got 50% exposure. Just, like that. I always toy with that idea, A different strategy for a bear market. But I think if I did it, I have to do it when you did it, Brian. I think, correct me if I'm wrong, Brian, but I think you were doing it on a big down day. Like the market was down big and you were doing it. I don't think you were buying it when the market had rallied, right? You said enough is enough. That's a location I'm willing to give it a shot, throw some more money at it. It's just not the ARMR investing way, but the ARMR investing way is dialed in for a particular type of market. And right now we're at the extreme of tail. And so the question that we really have to ask ourselves is, how do we best capture alpha? So my argument is I capture alpha when the risk monitor goes green, wherever it's trading. If this is a full-blown financial crisis, the market's going to go down a lot more than 10 or 20%. And I'm going to end up loading up a lot cheaper. Okay? But if this is just a tariff tantrum and deals are going to start to get struck and blah, 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 and the market's bottoming here, I'm probably going to be buying higher. And so I'm not doing it today, okay? But if the market gets whacked again and makes that double bottom, bang, and reverses, I might throw some money at it right there. That'll be before any algo will go green. That'll just be buying a location. The reason I wasn't willing to do it yet, first of all, I'm not really built that way. I think Brian was buying it down here. I don't know, but I'm not built that way because it's just crazy, and I don't like to put money to work, catch a falling knife. But if it comes back down and makes a double bottom, I'd be willing to give that a shot. So, come talk to me when that's happening. I'll be right back, guys.
So I'm going to be on and off the desk a little bit here. I got some guests coming over. I'm going to see them, but I'm coming back to the desk, just running back and forth now. Oh, come on. You got to be kidding me. You want to trade RX? I don't know, man. Not for me. Not today. I think Nova Gold for 10 cents is a winner. There's an idea that I can really get behind. Wow. Discovery Silver has just been a home run. Silver Fox, give him credit for that one. Oh, geez, I got to get back. I'll be right back. So what do we think here? It's 2:45. They're going to try to make a run to the close? Hang on a sec, guys. I'll be right back. Okay, what do we got? Markets, bonds have tried to stabilize. I mean, I'm really just staring at that. And I'm not trading the rest of the day here, so I'm kind of done for the day. But the only thing I'm looking to do is finish off my metal positions. I've got some more physical silver to buy, which is like really underperforming SLV. So I'm kind of a head scratcher there. Is that an opportunity or what? So in actuality, just looking at the numbers from the start of the year, SLV is up 11.2% right now, and Sprott Physical Silver is up 11.6. So it's trading at a 4% discount, and it's it doesn't go in lockstep with SLV. And honestly, this is partially why I put on an AGQ position this morning. So I've got an AGQ position on and a physical silver position. I want to go over this. How would I be trading this if I was constantly trading, constantly hedging? Well, I think what I would have said to you is instead of being stopped out on the S&P there, I would have carried some to see this yellow line here. This is the first standard deviation above the VWAP. Okay. So until it closes below that line, you've been walking up that line all day. All right. So in theory, this thing can keep on going as long as it stays above that line. And if you kind of try to look at the 1 minute chart and say what would equate to that, it's somewhere around that green line. Okay. So the black line is the most sensitive. The green line is the last line of defense when you're in an uptrend. See, we popped above it here at 11. We got on a trade at 1133. It went above it at 1137, and we've been living above it ever since with two challenges of the black line, which is more sensitive, right? So on the first challenge of the black line, I kept my core position and I went short. And as soon as it popped back above, I got rid of my shorts and I actually doubled my position again, but that's not the point of this conversation. And it popped up and I booked profit and got out of the whole thing when it challenged the black line again. You see what I'm saying? So if I wanted to stay on this trade longer, I would sell some in the pink box, keep a core holding for the yellow line here, right? And I would be actually short right now
after the pink box. The pink box, boom, I would hold a core and I'd be short. And then what would happen is if this yellow line gets taken out, I would get stopped out of my long position and I would be short. And if the market cascades down to the close of the day, I'm going to be making money in both directions. And so what I've been doing with you guys is flip trading. And what I'm saying now is I want to mesh the two and run it like a real hedge fund. And I've been looking at this strategy for the last couple of weeks. When the market went haywire, it became so hard to hold positions. And I had a couple of days there where I lost money and I was scratching my head saying, man, I should have made money on that. And so this is the development out of that adversity, if you will, right? So just following along, like where would I be? I would be short a position right up here. See, I would be short small caps right up here. Went down, rallied back, but it hasn't taken me out of the short. Same thing for the Dow. It stayed below the high of the bar we would have shorted. Okay, that would have been this bar right here. Because when you're hitting that first line and we're reducing our exposure, we're going to cover our short and we're going to go put on, let's make it pink. We're going to put on a short right there. And it has to close above the high of that bar for me to cover it. Somewhere right around there would have been the short. So I'm just curious how this plays out today. This would have been somewhere right in here. PMCL, Ares. Ooh, you got a good idea there with a nice dividend. You're right on the money on that one. I like that BVN call. And I do like the CMCL idea. .3% on Caledonia Mines? Are you serious? So Brian, you got SLVO? Brian B, SLVO. What is this? ETN, exchange traded note, first of all. Those always make me uncomfortable. Seeking investment performance corresponding to Credit Suisse Silver. So just a quick note, word to the wise there, Brian B. I never, ever buy exchange traded notes. I never buy exchange traded notes. And I learned that in 2008. So you could say to me, if there's no financial crisis, it's okay. It's okay. You can own an exchange traded note. I never own an exchange traded note. And the reason is in the small print, unless it's changed, so go Gronk it and find out, but in the small print, what is an exchange traded note? An ETN, not an ETF, an ETN. You're a creditor of the underwriter. You're a creditor of the underwriter. So in a financial crisis, silver going through the roof, but Credit Suisse or whoever the underwriter is having financial trouble, this asset won't work. How do I know that? Because I watched exchange traded notes in 2008 go to zero that were backed by Lehman Brothers. They had hard assets in them, supposedly. But when Lehman went bankrupt, it was just an exchange traded note backed by Lehman Brothers. So unless they've dramatically changed it, and it's possible they have, I just avoid it. I don't have any interest in that asset. Okay. And look at the downtrend in this asset. Why does the asset look like that? Silver doesn't look like that. Silver looks like that. So something's not right about that exchange traded note. I wouldn't mess with that personally. So I just wanted to, I think if you're looking for yield, I think Ares has got a good idea, 4.3% on Caledonia. That's an interesting idea. Question was, you've got about 27% of your portfolio in silver and precious metals already. Can you add to them? And so I am adding to them. So let me just go over my thesis here at 3 o'clock on why I'm adding to them. First of all, we loaded up yesterday on these Newmont, Franco, Royal, Wheaton, but this is, I know it might look like you feel like you've missed it. Well, you haven't missed it. You own 27%, but can you own more? I think these are epic weekly patterns. And I don't think these things look back from these patterns. We have been waiting forever for that pattern on GDX. Let me tell you something. Just to remind everybody, you already know this, so I'm not telling you something you don't know. Gold is up over 50% in 2025. Gold stocks haven't even remotely caught up to that type of action in physical gold. If physical gold's up 50%, January, February, March, and just a time, so let's say 3 months. If I told you that gold would be up 50% in 3 months, where are gold stocks trading? You would correctly tell me they must be up at least 100%. Maybe they're up 200%. I mean, that's like an astronomical move in gold. I've been trading gold since 2005. I mean, this is like an unreal move in gold. And what I said to you a while ago, a few weeks ago, maybe, I said, I didn't load up on gold at the start of the year. I left it to Silver Fox. He's running part of the virtual hedge fund, and he's got me covered. So I said, I'm gonna let him do his thing. So he's up huge, right? Talk to me. You're gonna have to talk fast, brother. What do you got? I can't help you now, brother. Can't do it. And so what I said to you when gold had this astronomical move in the first couple of months is, if gold is doing this, there's going to be a what's the word I'm looking for? There's going to be a moment where institutional investors wake up to the fact that they're missing a massive move in gold. Okay. And they're going to turn around and they're going to look at the mining stocks and they're going to say, oh my God, I haven't missed anything yet. And they're going to pile into mining stocks. And in my opinion, I said this a couple of weeks ago, this will be the year remembered for mining performance. Even though gold is up 50% already, I think the mining stocks are going to go berserk. Look at the weekly base. I'm not building that off of my own dreams. I'm looking at a massive weekly base. And so if you're like, what's the word I'm looking for? What's the fuse that lights that base? It's this week. It's a weekly inside out reversal bar of epic proportion on volume. Do you know the only animal that can make that happen? Who's the only animal that can make that happen? Those of you who've been with me know what the answer is to this. It's institutions. It's the elephant of institutions. They all just woke up this week and said, wait a minute, gold's up 50% this year and gold stocks are in this base? Forget it. I got to own it. Boom. And they just loaded up. This week had that massive down move. I stepped aside. I said, hey, man, I'm not going to hold on to these things. They're crashing. And then an unbelievable reversal, which Dad called. Hey, we got to give Dad credit. And he's making unbelievable calls, right? When gold was down at the 50-day moving average, and thanks for that call, Dad, because I started buying more physical gold. I actually added some physical gold there. But you were saying at the time, Dad, this is the time to go buy all the gold stocks. They're down the 50-day and it's going to be a V-shaped bottom. And I came out there and I said, oh, everybody relax, calm down. V-shaped bottoms are not statistically what we look for on this trading desk. And Dad said, respectfully, it's about to happen in these stocks. And he walked us through why he thought there'd be a V-shaped rally. He wins. That's the greatest call ever. Loaded up yesterday. 40% of the innovative growth portfolio is long, my favorite 4 mining stocks. I've added to it today. So now I've got physical gold, silver. I've got AGQ in the portfolio. I've got SILJ in the portfolio. So now I'm coming after silver. But for those of you asking me, do I think we can add now? I think there's your answer. And this is just, when I say add now, I'm increasing my positions to max now. We already own it cheaper, right? We all own it cheaper. I hope anybody on this desk owns some metal. So you already own it cheaper. And like you said, Brian, you got 27% there already. So this is the week, where I say I'm all in. That's it. I think we're gonna see a significant move here. So I've got a little bit more to go. And geez, I don't know. I don't know how much more I have to go. In the innovative growth portfolio, I don't have any more to go. So I'm 70% long the metals, and that's probably as long as I'm ever going to get in one portfolio. And in the macro fund, I'm 30%. Whoops. No, I'm more than that now. What am I now? Let's go take a look. Let's see where I want to be at the end here. Um, 10, so 30. I'll probably be close to 45 or 50% long in the macro fund. I'll be 45 to 50% long in the macro fund. And my flagship funds, I don't think I'm going to get bigger than 30% long, but I'll be 30% long by the end of the day. And we're already close to that number, I think. Let's take a look. And if you want to say to me, I want to wait and try to buy it on weakness Monday, I wouldn't argue with you. If it skyrockets without you, so what? You got a big position on. If it comes down on weakness on Monday or Tuesday, you get to buy some more. Yeah, I'll be 30% by the end of the day. It's early in silver. I mean, they haven't even come for silver yet. Hey, Casey, I really appreciate those thoughts, man. I mean, Casey, it's been lots of fun working with you guys today, and actually this whole week when we worked together. Is that Verizon up $2, 2%? What I say? Did I misspeak there? Yeah. Oh, geez. Thanks. Thanks for that. Whoops. I'd like to print a retraction. Thank you, Harris. I don't know where I got 50%. 22%. That's a lot easier. 22% is an epic move in gold. Thanks for that. Ah. Got a little carried away. What I meant to say, Eris, is gold will be up 50% this year, and I think GDX will be up 150%. That's what I meant to say. All right, CCJ. Yeah, it could be a double bottom in there. No doubt about that. Dad's calling out the assets behind CMCL are a little bit suspect, right? They're Zimbabwe. They're focused on Zimbabwe gold mines. And so Dad says be careful on that one.
These are some of the smaller names that Dad likes. Boy, I want more of the pipelines. Right. So following that strategy of being long and short, long a core and short against it. So I'd still be long a core, and now I would be out of the short side as the market tries to run up here at the end of the day. I'd be out of the short side. I'd still be long. For future reference. Yeah, I can see that. Okay, see that makes sense. So what you're looking for is a bounce that kind of runs the market up into, the downtrend, the 50-day, the 200-day moving average, and I'm with you on that. I can see that happening. Just so you guys who may not be with me, next week, what I'm just giving you my thoughts on where I would be. What are the key locations for me? If the market runs immediately up to the red line downtrend, the 50-day, the 200-day. Hey, by the way, I don't know if anyone's talking about it, but there's the death cross on the moving averages, right? There's the exponential moving average. I don't know, death cross. There it is, that ugly orange color, where the 50-day crosses down below the 200-day. And so it's going to be very hard for the market to get above it. So if it just rips higher into it, I'm going to be looking to be positionally short, swing trading on the short side. Right now, I'm just looking to, I day trade short and I'm looking to be long. But if we go right to that line, I'm going to be short. Now, if we come down and make a double bottom, then I think a structure's in. Or if we make a pennant formation in here, higher, something that sets up like this over a week or two. If we get something that goes like this for a week or two, then I would get more bullish and I'll try to buy the breakout. But if it goes straight to the downtrend, that usually is an opportunity to short in a bear market. It all keys off of bonds. And I'll be honest with you guys, particularly if we get that run in equities and Treasury bonds keep doing this. I can't believe that would happen. I think if we got a run in equities up to here, Treasury bonds will be rallying. They'd have to be. That would just be crazy if it shot up there with bonds continuing to break down. That'd be such an obvious short,
All right, so 3:30 update. Welcome to the 3:30 update. We do this every day for any Armor subscriber of any kind, right? So you guys can always hop in here to see Armor Insiders what we're doing at 3:30 if you can't trade all day. So changes to the portfolio. First thing we did here is build positions in physical silver, PSLV, and SILJ, which are the silver stocks, the silver mining stocks. Okay, so we already added this. Yesterday we put the Newmont, the finishing touches on our gold position, which was Newmont, Franco, Royal Gold, and then of course Wheaton is part silver, part gold. The gold part of the portfolio is skyrocketing, up 22% for the year. GDX up 45% for the year. And I continue to think that by the time this year is over, it's going to be a year remembered for the year that mining stocks finally got in gear. And I'm looking at this chart here that I think this is the fuse that's been lit, is this unbelievable weekly inside out bar on massive volume, right? Big volume move off of this GDX base. As you can see, the reverse head and shoulders that's in here, that would be something like that. There's the reverse head and shoulders, pretty obvious. Now you've got the uptrend. This is the week where they tried to sell it off last week because of the hysteria, and some early this week, and then just an explosion higher, clearing all of that price point. And I say to you, the only guy that can make that type of move happen, this massive inside out weekly move,
are institutions waking up to the fact that they need to own mining stocks. So we've got our exposure there to the miners, and we're kind of maxed out now. I've got whatever combination of physical gold, physical silver, big cap gold miners, and then the juniors of silver. Pan American is one of the biggest names in that fund, and Pan American, as you can see, is also in the process of reversing. You can see the relative strength already made a new high before the price. That's usually what we look for. It's relative strength breaks out and price follows. So, and you could actually see Pan American's like way behind, right? It should be trading up here at 40. So that's calling out that idea. Silver Fox likes that play, thinks it's an institutional play. Always has been. When it comes to the market itself, so our exposure right now in the flagship fund, if you're trying to follow along and take the information I'm sharing with you, I'm like 70% long in innovative growth, precious metals at this point. I'm about 40-50% long in macro. And the way I use that information for a flagship fund, which is capital that I'm managing for others, I've got about a 25 to 30% allocation. That's about right. There's a little more room in there if there's weakness early next week. I could bump up the 4 big names that I bought yesterday that skyrocketed. If they come in a little bit Monday, Tuesday, I might bump up that exposure another 5%, but that would be all I would do. The rest of our portfolio is Treasury bills, waiting for the market to change. We had some interesting trading today where we were long and short the market, and it really helped me maximize the gain on our carry trade today. It really did. I put a max position on right down at the double bottom at the opening range low, and in order to manage that risk, I had on a short position on small caps. So I put on a bigger position than I would normally put on, and I hedged it with small caps. And when it followed through, I covered the short and unleashed the full power of the position, and rode it all the way up here and did some other shorting in and around here to help me stay with a trade, and then really maxed out as it ran to our target. I would like to just point out to everybody watching along that the market went right to the target. I put this yellow box up here early in this move. I said that's the target. It's the ATR, the ARMR average true range high of the day. It went right to it. This green line here is actually the 4th Fibonacci extension above the opening range high. So that's usually all the S&P has in it on a normal day. Hey, today was a normal day. How much fun is that? Market's up less than 2% on the day. We need 2 things. I highlighted it in the morning meeting to get me more bullish on the market. I need 2 things. One, I need to see volatility compress. I don't like 9% days. I don't like 5% swings. That's not normal. It's on the wrong end of the bell curve. We want the fat part of the bell curve, right? So we want to see that. Today was the first day. I'd like to see a series of days where volatility gets back to something normal. That will begin to set up a base that we might be able to see a better move from. And the other thing is the bond market. The bond market's just not cooperating right now. Equities are trying to rally. Bonds are still locked in their downtrend, and this is what I mean by that. So, during the insane week, this day right here, right in here, the market was up 9.5%. Bonds were still in a downtrend. Bonds didn't really respond. They gapped down, they rallied back to the trend, and they just keep going lower all week. This, to me, is what's really happening with tariff negotiations. You could get all kinds of tweets from Truth Social, and they don't mean anything from an investing point of view unless bonds start going up. Because I think what's really happening is bonds are getting sold by our trading partners who are, quite frankly, annoyed with the tariff tantrum that's going on. And so while they're negotiating, they're dumping bonds. If that's what's going on. So I'm kind of reading into that, but
if bonds start to go up and rates come down, I think everybody's getting back to more normal expression of trade negotiations. I just haven't seen that yet. So I'm not willing to carry anything long over the weekend other than precious metals for obvious reasons. And if the market were to gap up and just run right to the downtrend, this is what you call a death cross on the NASDAQ 100. When the 50-day moving average, I use exponential. So when the exponential 50 crosses below, in this case, it's crossed below the standard 200 and the exponential 200. This is a major problem for the market right there. That right there is a major problem. I don't know what color to make that, but I don't know. I made it some kind of ugly orange before. Ew, I want to make it ugly so that everybody looks at it and goes, "Ew, that's gross." Yeah, it's totally gross. That's a major problem for the market. So if it has this huge up day, consolidates, and then Monday, Tuesday runs up to this line in a straight line, that would be too much volatility. That would be an opportunity to short. I think it would get up there, go like this, roll over, and crater again. If we're looking for a long opportunity, we need to see the market do something like, like this. And I don't even know where to draw this, but I don't know, something like that. And start building a tight wedge, where the trading gets tighter and tighter in here. I don't want to see wild swings. I want to see it get tight, and then pop out that side. I might get long for that trade. But if it just skyrockets, that's not a trade I would be looking to short that skyrocket. So anyway, those are my thoughts for today. Any questions you guys have, feel free to throw it out there. Happy to answer. What do we got? Trump market. All he needs to do is make cannabis great again. What was I going to say to you guys? Oh, yeah, that was a cannabis question. Somebody asked me a cannabis question. What's the... Oh, we have it here too on the S&P. This is the week of the death cross. I bet small caps did it a while ago. Yeah, here's the death cross in small caps. Hey, so you get the death cross, and look, small caps rallied up. The death cross doesn't mean it has to crash. It just means on rallies you start shorting. That's what that means. Until such time as a bigger base gets built.
Happy to do these live streams with you guys. When things get real hairy, I'm happy to step out and help all that I can. It's just, it's part of the fun of working with you guys and sharing information. I dropped a link into the comment section. If you want to take it a step further, feel free to check that out. Oh yeah, Brian, I was going to answer. Brian B, are you still with me? So first of all, I'm Brian. Dennis, I'm not going to hold shorts overnight again, unless the market were to rally right up to that downtrend, and I would try a short overnight. But you could see what happens, Dennis. I don't recommend most people short, and you could see what happens when you short and you get caught wrong. The market jumps 9.5%. I mean, it'll blow your head off. I mean, it's just not a market to be short overnight. We could be short, and at 1 in the morning, China announces that they want to come to the table and they think there's a great deal. I mean, the stock market's up 10% and we're short. It's just not worth the risk. I can't. It's not a normal market. I can't do it. I'll short intraday, and I'm really using the shorts to hedge long positions. That I'll do. I don't know. And I think if I did go, quote, short, let's say the market rallies up to the downtrend and I want to put a short out, I'm going to do what Chicago Dave talked about, which is I'm going to buy puts. I can't have unlimited risk. I'm going to take whatever I'm willing to lose, and I'll buy some puts on it up there. Skyrockets, all right, I lost that money, and I live to fight another day. Craters, and I might make a lot of money. That's what I'm going to do. Stephen, so far I just own in my dividend portfolio. I reduced it to AMLP and AT&T, and I'm not willing to rebuild it until I feel the market has reached a reasonable bottom. I'll start rebuilding that, Stephen, when volatility compresses and the bond market breaks the downtrend, and actually consolidate. It's not just breaks the downtrend and starts to build a base. And I feel like, okay, rates aren't going to skyrocket anymore. And I'm going to go out there and I'm going to rebuild, Stephen, all my favorite names. I'm going to buy back the utilities. I'm going to buy back the tobacco. I'm going to buy back Verizon. I'm going to go right back into my favorite names, some of which we're going to buy cheaper. Some I might pay a little more for. I don't care. I had to protect capital first. And then I'll go rebuild that portfolio. But I'm not at the rebuilding phase just yet. I can't rebuild. Look what's going on in Treasury bonds. So if they stop here, they build a bottoming wedge here, and they break out of the bottoming wedge, I'll rebuild. Brian B., are you there still? you there. All right, I'll write him a note here. Hey, what's up, Gary?
Question coming in from Emerald. Emerald Crucial. How you doing? Nice to see you. Are the announced tariffs to come in pharmaceutical, do they bias making, does it make the pharmaceuticals riskier? I already thought pharmaceuticals were risky. You know, when RFK Jr., was added as the health czar, if you will, it made pharmaceuticals too risky. We made a lot of money this year trading Gilead. So I love the pharmaceuticals when they're right. We bought it down here, and then we added to it here, and then we sold it all up there, and we collected some dividends along the way. We owned AbbVie for a while, but as you can see, we sold it up here, so we just avoided that collapse. We've traded AbbVie a couple times. I kept looking for a room into Pfizer, and it just never worked. We had a small position on, and when it broke down out of that pattern, we got out of that. So we made some money in Bristol Myers, and then it just tanked. So we tried Bristol. We made some money in Bristol here, and then we put Bristol back on here, and then we had to get out. I think this was probably the day we exited. I think on that day, and just all bets were off. I mean, things were just, you couldn't stay with them. And so I'm not that attracted to the pharmaceuticals at the moment. I'll watch them and see if something sets up. But between tariffs and the new government with Trump and RFK Jr., we don't really know what they're going to do. That's just too much risk when it comes to a dividend portfolio. I've got other places where I'd rather go for dividends. Like, for instance, I can't wait to get back on our tobacco trade. We've been making a lot of money in tobacco. We bought it in here, we added to it here, and I removed it. I don't know, I think it was this day when I removed it, somewhere in there, because I got to protect capital when the world is falling apart. But I'd like to get back on. There's a real fundamental story in tobacco, which has to do with the fact, so these stocks paid, 9-10% yields, and they're totally changing their business. The reason we've been on farm tobacco is that I don't know, maybe a year or two ago, we started really focusing on the space. We were on a conference call with the management of Philip Morris, and he was explaining on that conference call that in a decade, they're not going to be selling any loose leaf tobacco products. They're not going to be selling rolled cigarettes. They're trying to get to the point where all of their products are derivatives, whether they're vapes or whatever else they're going to do, by the way, which carry which allows them to say that these are healthier than cigarettes, because the FDA allowed them to say that, and I guess they are. And when you think about it, it's a growth story, because they're going to go from selling a commodity volume business of tobacco rolled in paper, which is just a commodity, and they're going to shift to something that has intellectual property and higher margins. That's where this business is going. And so Philip Morris and Altria and British Tobacco, these are really great long-term investments with a fat dividend yield. So when it comes to my dividend portfolio, where do I want to go to rebuild? Utilities, tobacco, telecom. Those are my three spaces. Oh, and energy. Those are four spaces. The energy of pipelines. I just like to own the pipelines. So I own pipelines now, but I've owned them for a couple of years, and I'm going to increase that position. Okay. And I own AT&T still. And then I can't wait for this volatility to compress so I can go out there and start putting these names back in the portfolio. Woo! That was a long week, crazy week. I'm tired. Let's break. I'll see you guys next week. Thanks so much for spending time with me today. I hope you all had a successful trading session. I think that's it, guys. I'm going to sign out. Take care, everybody.